Hi, welcome back to the Smart Money Stack. I'm your host, Ramiz Ali, certified blockchain expert, senior executive in crypto, and author of Programmable Finance, The Future of Money in the Tokenized World. If you've been following along, you know that on this show, we break down the future of money, programmable finance, stablecoins, tokenization, and how the rails of finance are being rebuilt in real time. But today's episode feels different. It feels like a turning point. Because for the first time in decades, the old guard of global payments, SWIFT, is being challenged. And not just challenged, but forced to reinvent itself. If you've ever seen an international wire transfer, whether it was 500 to family overseas or 5 million between businesses, chances are the transaction rolled on SWIFT rails. SWIFT has been the invisible backbone of global money movement since the 1970s. It connects more than 11,000 banks across 200 countries. It moves trillions of dollars a day. It is, without exaggeration, the nervous system of traditional finance. But here's the twist. SWIFT doesn't actually move money. It moves messages. It tells banks what to do. And the system, built on layers of correspondent banks, compliance checks, and legacy rails, is slow, expensive, and opaque. Enter stablecoins, digital dollars pegged one-to-one to fiat currencies running on blockchains. They don't care about weekends, time zones, or correspondent banks. They move instantly. They're programmable and they're growing at a pace that's making central bankers sweat. So here's the headline. In September 2025, SWIFT announced it's building its own blockchain-based ledger, with backing from major global banks and technology partners like Consensus. For the first time, the old rails are admitting that the new rails can't be ignored. So in today's episode, we're going to dive into what SWIFT really is and why has it ruled payments for so long, why stablecoins are the first existential threat it has faced, SWIFT's blockchain pivot, what it means, what are the risks, and why it's happening now. How stablecoins, CBDCs, and tokenized deposits might collide on the same rails. What this means for investors, for banks, and for you. This isn't just a tech story. It's about the very architecture of money, so let's get into it. Part 1, SWIFT, the old rails that still rules. To understand the significance of SWIFT's pivot, we need to start with what it actually does. SWIFT, the Society for Worldwide Interbank Financial Telecommunication, was founded in 1973 in Belgium. Its purpose was to replace telex machines with a standardized, secure way for banks to send messages to each other. When you wire money internationally today, your bank doesn't beam dollars across the ocean. What it does is send a SWIFT message to another bank or to a chain of correspondent banks, instructing them to debit and credit accounts. The actual money moves through Nostro and Vostro accounts, pre-funded balances that banks hold with each other. That is why international wire can take 2 or 3 days. Your bank has to send a message. That message has to go through multiple banks. Compliance checks are run. Sometimes currency is converted. Sometimes time zone delays settlements. Each step introduces friction, and each bank takes a cut in the fees. Despite that friction, SWIFT became the gold standard. Why? Because it created a common language for banks. Before SWIFT, international transfers were a nightmare of telex codes and bilateral agreements. SWIFT standardized all of that. It built trust, it built security, it built scale. Today, SWIFT connects more than 11,000 financial institutions in over 200 countries. It processes more than 40 million messages a day. It has survived technological shifts, regulatory overhauls, even geopolitical crisis. It is quite literally the backbone of cross-border money movement. But SWIFT has a problem. It's a messaging network, not a settlement system. It tells banks what to do, but it doesn't actually move money itself. In a world where money can be tokenized and moved directly on a blockchain, the idea of sending just a message and waiting for reconciliation feels outdated. Yes, SWIFT has tried to modernize. It has upgraded to the ISO 20022 messaging standard. It has experimented with faster payments, APIs, and real-time gross settlements integrations. But these are incremental fixes. They don't change the fundamental architecture. And that's why SWIFT feels threatened now. For the first time, a new technology exists that can both message and move value at the same time. That technology is stablecoins. Part 2, Stablecoins, the disruptor. So what are stablecoins and why are they such a threat? Stablecoins are digital tokens pegged to fiat currencies like the US dollar or the euro. They're issued by private companies like Tether or Circle, or in some cases by decentralized protocols like Maker DAOs, DAI. Each token is designed to maintain a stable value, usually $1 per coin. Unlike Bitcoin or Ethereum, which fluctuate wildly in price, stablecoins are meant to be boring. One coin, $1. That stability makes them useful for everyday transactions. Why do people use them? A few reasons. First, speed and cost. Sending a stablecoin is like sending an email. It's nearly instant, and fees are often pennies compared to the $30 or $50 fees of international wires. Second, accessibility. You don't need a bank account to use stablecoins. All you need is a smartphone and a crypto wallet. In countries with weak banking systems, unstable currencies, or high inflation, stablecoins offer a way to hold value in dollars and move it globally. Third, programmability. Stablecoins live on blockchains, which means they can interact with smart contracts. You can create escrow payments, automated settlements, decentralized finance applications, all running without human intermediaries. Fourth, trading and liquidity. Stablecoins are the grease that keeps the crypto markets moving. Traders use them to move in and out of positions without converting back to fiat. They're the base pair for thousands of crypto trading pairs worldwide. But perhaps the most important point is this: stablecoins collapse the gap between messaging and settlement. When you send USDC on Ethereum, you're not sending a message that instructs banks to settle later. You're actually moving the value in real time. That's what makes them such a disruptive force to Swift. Of course, stablecoins have risks. They depend on the reserves backing them. If the issuer mismanages reserves, you risk a depeg. We saw this with algorithmic stablecoins like Terra's USD, which collapsed catastrophically. That's why regulators are stepping in, requiring audits, disclosures, and strict reserve management. But even with those risks, stablecoins have exploded. The market is now worth more than $160 billion, with USDT and USDC leading the way. And they're just not being used by crypto traders. They're being used for remittances, for salaries, for savings in inflation-stricken countries. In short, stablecoins show the world that money can move without SWIFT instantly, globally at a scale, and that's why SWIFT is taking notice. Part 3, SWIFT strikes back with blockchain. So let's talk about the bombshell announcement from September 2025. SWIFT revealed it's building a blockchain-based shared ledger. Not a pilot, not a lab experiment, an actual infrastructure play. And it's doing this in partnership with Consensus, one of the biggest Ethereum infrastructure companies and more than 30 global banks. The goal is simple but bold: to enable 24/7, always-on, cross-border payments that can support tokenized value. That includes stablecoins, tokenized bank deposits, and potentially even central bank digital currencies. Let's break down why this matters. First, it's an admission. SWIFT is acknowledging that blockchains are not a fad, that stablecoins and tokenized assets are here to stay, and that the only way to remain relevant is to integrate them. Second, it's a defensive move. If banks start moving stablecoins directly over Ethereum, Solana, or Polygon, SWIFT risks becoming irrelevant. By offering a blockchain ledger, SWIFT hopes to keep banks inside its orbit. Third, it's about compliance. SWIFT's value proposition has always been trust and standardization. By embedding compliance checks, audit trails, and regulatory controls into its blockchain, SWIFT can offer something that public blockchains struggle with: regulatory comfort. But this won't be easy. There are challenges. Governance. Who controls the ledger? Is it centralized under SWIFT or distributed among banks? Performance. Can this ledger handle the throughput of global payments with low latency and high reliability? Regulatory fragmentation. Will the US, Europe, and Asia all agree on how to treat tokenized value on SWIFT rails? Adoption inertia. Banks are conservative. Many are still hesitant about blockchains. Getting them to adopt a new system will take time. And of course, competition. Public blockchains like Ethereum already move billions of dollars of stablecoin daily. Why would a fintech startup or a DeFi protocol choose Swift's blockchain over Ethereum? Swift's bet is that banks will, that the brand, the trust, and the compliance baked in will matter more than an open access, that corporates and institutions will feel safer transaction on Swift front ledger than on a public chain. In other words, Swift wants to be the bridge, the middle ground between the wild world of crypto and the regulated world of traditional finance. If it succeeds, it could cement its relevance for another generation. If it fails, it could end up being bypassed by the very rails it's trying to integrate. Part 4, the hybrid future. Here's the reality: the future of money is unlikely to be all Swift or all stablecoins. It will be a hybrid. On one side, you'll have private stablecoins like USDC and USDT. They'll continue to dominate DeFi, crypto trading, and cross-border flows where banks are absent. On another side, you'll have CBDCs, central bank digital currencies, the digital euro, the digital yuan, maybe one day a digital dollar. These will be legal, tender, government-backed, and tightly regulated. And then you'll have tokenized deposits, bank-issued digital tokens that represent digital deposits. These could be the bridge between banks and blockchains, offering programmable features while staying within the regulatory parameter. Swift's blockchain ledger could be the place where all three of these forms of value meet, where a company can send a tokenized deposit from a bank in Germany, settle it instantly against USDC on Ethereum, and convert it to a digital euro CBDC, all with compliance and auditability. That's the vision, a multi-asset, multi-rail future where Swift is no longer just a messaging system, but a settlement platform for the digital age. Of course, that future isn't guaranteed. It depends on execution, regulation, and adoption. But it's the direction we're headed. Part 5, what this means for you. So what does all this mean practically? If you're a bank, it means you can no longer ignore stablecoins. Whether you like it or not, your customers are using them. If you don't integrate, you risk disintermediation. If you're an investor, it means the picks and shovels of tokenization are worth watching. Stablecoins issuers like Circle and Tether, infrastructure players like Consensus, custodian compliance tech, and tokenized platforms. These are the companies building the new rails. If you're an everyday user, it means sending money abroad might finally get cheaper and faster. It means businesses might finally be able to settle invoices instantly instead of waiting days. It means inflation hit population might get reliable access to digital dollars. Think about what email did to letters. Think about what streaming did to cable. That's the kind of shift we're talking about with money rails. In closing, the old rails and the new rails are colliding. Swift, once untouchable, is now building a blockchain ledger because of stablecoins. That tells you everything about the scale of this disruption. Will Swift adapt and dominate the extra era of payments, or will it become a bridge technology eventually bypassed by open rails? Nobody knows for sure, but one thing is clear. The rails of money are being rebuilt right now in real time. That's it for the Smart Money Stack. If you enjoyed this deep dive, share it with a friend who wants to understand the future of finance. Subscribe to the podcast wherever you listen. And if you want the full framework, grab my book, Programmable Finance, The Future of Money in Tokenized World. Until next time, I'm Ramiz Ali. Stay smart, stay ahead, and stay ready for the future of money.